How central banks buy quietly. The London OTC market. Most central bank gold purchases take place over the over-the-counter market in London rather than on public exchanges. This market structure allows very large transactions to be executed discreetly without attracting media attention or causing sudden price movements. The local London standard dominates these trades, enabling gold to change ownership within London vaults without the metal physically moving. For central banks, this approach is essential. Buying quietly helps avoid pushing prices higher against themselves and allows reserve managers to operate efficiently in a market where transparency and discretion must be carefully balanced. Role of the Bank of England. The Bank of England plays a central role in facilitating this quiet activity. It provides custody services and maintains gold accounts for dozens of central banks and international institutions. These accounts allow gold to be transferred, pledged, or swapped quickly within the London market. While the Bank of England publishes monthly data on total gold holdings in custody, this information is released with a time lag. That delay preserves operational discretion while still meeting modern transparency expectations. Infrastructure in this sense enables silence. Indirect and technical purchases. Not all gold buying happens through direct market purchases. Central banks may use intermediaries such as the BIS, convert older bars into modern market standards, or rely on leasing and swap arrangements when liquidity is needed. These technical processes highlight an important point. Gold buying is not just strategy, it is also logistics. Where the gold is stored. London as the primary hub. London remains the most important and most popular custody location for central bank gold worldwide. Its role is based on deeper liquidity, a highly developed trading infrastructure, and decades of institutional trust. Gold stored in London can be traded, swapped, or pledged within hours, often without leaving the vault. For reserve managers, this immediate access to global markets is critical, especially during periods of financial stress. Liquidity is the key reason why London continues to dominate, even as some countries reconsider where they store their reserves. The return of repatriation. At the same time, a growing number of countries have chosen to bring part of their gold back home. Germany completed major repatriation by 2017, Austria diversified its storage locations, the Netherlands moved gold back in 2014, and India repatriated more than 100 tons in 2024. These moves were not driven by logistics alone. They carried strong political and symbolic meaning, emphasizing sovereignty, domestic control, and public confidence in national reserves. The dual home strategy. Most central banks now pursue a balanced approach. Part of their gold is stored domestically for security and sovereignty, while another part remains abroad for liquidity and flexibility. Control and access must coexist. National buyer case studies. China and India. China and India provide two important examples of how gold is used within national reserve strategies. China resumed steady gold buying after brief pauses, signaling a long-term commitment rather than short-term opportunism. Gold plays a role in managing foreign exchange exposure and reducing dependence on US dollar assets. Although official disclosures are limited, steady accumulation sends a clear message to markets. India, meanwhile, increased gold to approximately 11.7% of total reserves. Beyond the numbers, India's decision to repatriate significant quantities of gold carried strong symbolic meaning, reinforcing national control and public confidence in reserve management. Turkey and Singapore. Turkey demonstrates how gold can be used operationally rather than purely as a passive reserve. During periods of domestic stress, the central bank sold gold to stabilize local markets, then rebuilt reserves once conditions improved. Singapore followed a different path. It sharply increased its gold holdings over a short period, positioning itself as a regional leader in reserve strength. In both cases, gold served not only as a store of value but as a flexible policy instrument. Diverse motives, common asset. Although each country has unique economic conditions and policy goals, all value gold's independence and flexibility. Gold unites these diverse strategies as a shared response to global uncertainty and financial fragmentation. Legal and market lessons. The Venezuela case. Venezuela's experience offers one of the clearest real-world lessons about the risks associated with storing gold abroad. 31 tons of Venezuelan gold held at a foreign central bank became inaccessible for years due to a legal dispute over political recognition. Even though the gold was formally owned by the Venezuelan state, courts tied access to political decisions rather than ownership rights. This case made it clear to reserve managers worldwide that legal jurisdiction and political context can override formal claims. Ownership alone does not guarantee control when assets are held outside national borders. Why not use ETFs? Central banks overwhelmingly avoid so-called paper gold, such as exchange-traded funds. Instead, they prefer physical gold bars stored in secure vaults. The reason is simple. Physical gold carries no issuer, credit, or redemption risk. In times of crisis, ETFs depend on market functioning and legal structures, while physical gold can be directly pledged, swapped, or mobilized. For institutions responsible for financial stability, direct control matters far more than convenience. Market effects of quiet buying. Quiet accumulation has broader market consequences. Delayed disclosure can distort official statistics, while sudden leasing demand can tighten liquidity during periods of stress. Even without public announcements, central bank behavior reshapes market dynamics in subtle but powerful ways. What it all means going forward, implications for states. For governments, gold has clearly evolved into a modern sovereignty reserve. It is no longer viewed simply as a historical asset, but as a practical tool for managing extreme risk. Gold supports crisis financing, enables bilateral swaps, and provides external liquidity when access to foreign markets becomes restricted. Unlike foreign-held bonds or deposits, gold remains usable even when sanctions, legal disputes, or geopolitical tensions disrupt global financial systems. As a result, reserves are no longer purely financial buffers. They have become geopolitical instruments, and gold sits at the center of that shift. Signals for businesses and savers. Strong national gold reserves send important signals beyond central banks. For businesses, especially exporters, reserve strength improves sovereign credit confidence and can reduce financing costs during periods of stress. Stable reserves lower perceived risk for lenders and trading partners. For individual savers, central bank behavior provides a powerful signal. When institutions responsible for long-term stability increase gold exposure, it suggests a preference for independence, resilience, and protection over short-term yield or speculative return. Looking ahead to 2026-2027. Gold buying is expected to continue, but not in a smooth or predictable pattern. Purchases will likely remain uneven, shaped by prices, logistics, and political considerations. Communication will stay discreet, and further repatriations are likely. The era of quiet accumulation is far from over, and gold's role as strategic insurance is now firmly established.